Yes, it's being recorded. Okay, perfect. Got you guys can hear me fine. I can see it in the comment box. Awesome. Okay, so with bullish sentiment here, we've got the opposite. So it's inverted from the bearish market structure. We've got the open, low, high, close. So as I was saying, you've got the opening of the candle. The low is formed. There's a tiny wick there, as you can see. Then the high, and then the close. So open, high, or low, high, close. Open, low, high, close. Open, low, high, close. So now that you can see this in market structure, you can understand that, at the beginning of each day when the new candle is formed, you're going to be able to understand, okay, we're going to be looking for the high of the day or the low of the day if it's in a bullish sentiment. We're going to be looking for the low of the day at the beginning of the candle and know that we can ride that out in trending markets for the majority of the day, and then close within the lion's share of the move. We're going to be obviously talking about this more in depth throughout the webinar. You can see the same structure here. So you got the opening, the low, high, close, opening, low, high, close, and it's the same thing, right? So they're looking for the most amount of liquidity to keep the move continuing going up. This is obviously, once again, on a daily chart here. So as you look at this, you see some wicks going down. That's, most likely faking most traders out on the bearish side, grabbing the liquidity to go up. So on a daily chart, this could be, quite a few pips, but you know that market structure is poised to go higher. So you don't want to be getting faked out, which I see the majority of traders getting faked out on these down moves. All right. So just to recap, as the new daily candle or 4-hour candle opens, know that in a bullish sentiment, price will first open, go lower, make a low, go higher, make a high, and then as the day proceeds and ends, the day slightly lower than the high of the day, within 20% of the top of the candle. It will close, and within 20% of the bottom of the wick of the candle, it's going to open. So I'm going to go through some custom indicators you're going to need going forward. I'm going to be sending them out into the chat rooms after this webinar, so don't worry too much about where you're going to get them from. I'll be sending them out. These are going to be these are not indicators in the sense of lagging indicators. These are indicators that just show basically time and price action during specific periods. So you'll see that as I start to explain it. These indicators have been absolutely remarkable in trading, and once you see these price patterns in the charts during these certain times, it's gonna change your whole aspect of trading. So the first one that we're going to be going over is the range session indicator. It's called the Asian session. It's not representation of the Asian session. It's basically just captures the range of the high and the low over a certain duration of time. So this indicator is going to be the first one that's going to be given out, and the first one we're going to go over. The general settings once you open the indicator are going to be these time slots. So you have 0 GMT and 8 GMT. You're going to want to change that to 20 GMT and 24 GMT. Now I'm going to be explaining why you're going to be wanting to look at these times specifically. And then once again, the links are going to be given out after the webinar. And this range for these time periods here is going to be the central bank dealing range. So I'm going to be explaining basically what's going on during that time and how the central bank is manipulating price in order to grab liquidity and seek liquidity to continue its overall move. So the next one we got here is going to be the London Kill Zone Range Session Indicator. So it's going to be this. You're going to use the same indicator. You're going to have two of them on your screen. So you're going to have the first one is going to be the central bank dealing range, and then this one is going to be the London kill zone range. So you're going to change the general settings once again to you change it from 0 GMT and 8 GMT as the default settings to 9 GMT and 11 GMT. Now, the reason why I'm using these numbers is through my brokerage, these are the time zones as far as the brokerage that I use. My time zone is GMT +2, so I changed some of my indicators around to match the price data conveyed inside my charts. So you might have to do the same depending on your brokerage, but these are the times that I'm using. So I'm using 9 GMT and 11 GMT, which this is representing of is London Open. So that's what I'm trying to capture in that time zone is just London Open, where you're going to see, I'm going to be explaining how you're going to see the bulk of the move happening and some great entry points happening at these times. So typically you're going to see the higher the low of the day during the London kill zone range. So that brings us to the next indicator we're going to be needing, which is the multi-timelines or the time division indicator. So this is another one I'll be giving out inside the chat. We've got the default settings here of 7, 8, 14, 15, 0, 0, 0. I've changed them, and this is the numbers you're going to want to change them to is 0, which represents, 0 represents the start of the day. So I'm going to be explaining this a little bit more in depth as we go on, so don't be too worried. 0 is the start of the new day according to my charts. 5 GMT is what we're going to classify the New York Open candle to be. So this is what we wanted basically put as, this is the time that the central bank dealing algo and dealing range clocks in a lot of their prices, and you see the manipulation after this time. You're going to see examples that are going to blow your mind as I go throughout this webinar. 5 GMT is going to be the next indicator you're going to want to put. Then you have the next start time of 0. Then 20, what 20 represents is that's the end of the day. So that's pretty much the end of the day where you're going to catch the bulk of the move. So I was explaining how you have the open, high, low, close of the candles. So you've got the open, you got the open, then you got the high, then you got the low, and then the close, right? So this is going to be, this is the time period when you're going to see the close of the candle happening, where you can be confident in knowing that you've caught the majority of the move. Then 05, 05. So that just basically continues to put those same numbers on your screen over a period of time. So yeah, change the first numbers, the default settings, to the second numbers. This is going to be recorded, so you'll be able to come back to this or ask questions and see what the indicators numbers are that you're going to have to be changing. So don't worry too much about writing this all down right now. So the next one I want to bring us to is how your chart's going to look after. So as I was saying, you've got, I gave out 3 indicators on here. So the first one was going to be the central bank dealing range, which is this time here. You got the highs, and you got the high, and then the low of the central bank dealing range here. So that's captivating this whole movement in here every day. Now this is going to be important. I'm going to be explaining a little bit more about this. And then you've got, if you look, you've got the London session kill zone here and here. So every day you've got the London session kill zone, as I've written out in the webinar, and you can see, this is where you're catching the bulk of the move here, is boom, and then you've got your time zone inclination. So you've got 5 GMT, which is the start of the New York. We like to call that the central bank dealing range. This is where the manipulation happens. So this is where I'm going to be explaining this more in depth, but you're going to be looking for the opening of this candle on this time to have price manipulated until coming into London session. So as you can see, price drifts away from this on the upward move, and then you catch the massive drop. Obviously the sentiment here is bearish, so you can pinpoint better entries using this market structure. So then you've got 0 GMT is the start of the day, 5 GMT, and then we're going to be talking about this number a little bit more. This is going to be 20 GMT. So that's going to be where you're going to be catching the bulk of the daily move. So the central bank dealing range London kill zones, 0 GMT delineation, as we've said, is the brand new start of the day. 5 GMT delineation is the brand new day New York candle, New York midnight. You'll be treating this time as if it was the opening price of a daily candle on your chart, and by doing this you'll catch the bulk of the move. Now the reason why we're using 5 GMT, the reason why these numbers aren't exact to the opening price of the candles on your charts, your brokerage, is because the brokers aren't the ones that are moving price, okay? So it's the banks that are manipulating and moving price to where they want inside the charts, not the brokerages. The brokerages are obviously offering their service. They're not, in the sense, the way that the market moves its structure, right? So why we pay attention to these numbers here is by knowing what the central bank's doing during this time, you can obviously be able to tell, where it's trying to send price to. Now we try to lay out our brokerage platform in MT4 the same way that the central bank would have its laid out in the United States. So basically we know that everything that's a major currency is pegged against the US dollar. That's why we want to pay attention to these times specifically, not our Australian time or whatever brokerage that we're using. So 20 GMT delineation is the end of the day, as I've stated, and it's going to be the lion portion of the move. So the range indicator, it's going to change from, you're going to change the default settings to 18 and 23 GMT, 23:59 GMT, which is 1 minute before the end of the day. The settings, the highest high and lowest low between central bank dealing range session and prior to the new day at 0 GMT. So you're going to look for 1.5 to 2 standard deviations from the central bank dealing range to take your position on average. Now I'm going to be explaining what standard deviations are and what I mean by that. And you're going to use the confluence of price being above the opening price of 5 GMT or below the opening price as a level that central banks will be grabbing liquidity depending on the directional bias. So what that basically is saying is, obviously with a long-term directional bias, it's what we'd like to start our strategy with, obviously. I like to, at least, and I highly recommend it because it really brings a lot of insight into your trading strategy. Using the confluence of the opening price at 5 GMT, you're able to basically tell which way price is being manipulated, and once the London Open kill zone comes into play, you're able to take an entry almost always at that period. For certain times of the day, for certain pairs, this is mostly, I'm going to say this is mostly a strategy for Great Britain pound. It also works on Euro USD. Not too much on some of the other pairs such as the Asian sessions. It does work slightly on them as well, but I would stick this strategy to the pound and the euro. So what is a standard deviation? As you plot out all the indicators that have been previously mentioned, you'll first start by determining the high and the low of the central bank dealing range, as we've talked about. Once you plot out the levels of the central bank dealing range, you'll be able to use them to predict price action to be manipulated 1.5 to 2 standard deviations on average away from the bank dealing range before price returns to its original direction. which is the long-term sentiment. A key factor in determining which direction price is probable to reach to after the manipulation is to have the higher time frame bias, or using the techniques that will be talked about later in this webinar. Obviously, as we've said, the higher time frame bias is what you want to always have in mind. So what a standard deviation looks like. So you've got the central bank dealing range high and low, which will be your focal point for plotting out your standard deviation. So you've got, this is the central bank dealing range. Let me get the spotlight out. You got your central bank high dealing range high here, and then the central dealing range of the central bank low here. This is what you're going to use as your market structure to plot out your highs and your lows, representing one standard deviation. So what do I mean by that? Let me show you some examples. So as we go into the next slide, as you can see, I've filled in this box here. Now what this represents is, this is the central bank dealing range. Once the high and the low is filled in, you can use some, if you go into insert on your charts, you can insert shapes. I like to fill it out with just a shape, and then you know, draw that shape out. I'm going to show you in the next slide. You know, draw the same level of the same shape out, and then that of the high and the low, and that's going to represent one standard deviation. So this is one standard deviation in price. So as you can see, you know, having a higher time frame bias in the direction of the market, and knowing that we're most likely going to be having bearish market structure. You can see down here on the 15-minute, as we plot down our time frames, you've got one standard deviation here. You've got the central bank dealing range. As I've said, you know, after 5 p.m. you're going to see manipulation in price. So you know that after 5 p.m. the opening of the candle, you're going to, if we're looking at long-term sentiment knowing that we're going bearish, you're going to see at this candle here, price after this candle until London open, price is going to be manipulated in the opposite direction. And as you see, this is true. And I'm going to show you more and more examples in the charts after this. I'm going to bring up my MetaTrader 4 and show you some examples. But as you can see, you know, we're looking for price to be manipulated at this zone, come into London, and then anywhere at the beginning of London open is a great spot to be taking a short position, as you can see, you know. And even if you had a 20 pip stop here, as price comes back up, you know, you still got your stop, wouldn't be stopped out even if you moved it down, catching the majority of this move, wouldn't be stopped out here, and then boom. So I'll be showing you some more examples of this as obviously we're going further. If you guys have any questions, feel free to put them into the question box on your right hand side as we continue to go forward. So reference the same levels as the one standard deviation. So, you know, we've got one standard deviation here. You know, you draw this across in time, and it's just slightly over one standard deviation. And as we've said in the previous slides in this webinar, we're looking for 1.5 or 1 to 2 standard deviations in price manipulation before we can have like the highest level of conviction in our trades. It doesn't have to be that much. It could be 1, it could be 2, and I'm going to explain that the most you're going to see is obviously 3 standard deviations. So let's go to the next slide. So 1.5 to 2 is typically the levels for the standard deviation that you're going to see in price, as we've said. 3 is going to be the max. So if you draw this across, you know, you've got 1 standard deviation there, maybe 1.25 here, and then boom, price drops. So this is a level of confluence that you're going to add into your trading. I'm going to show you some more examples as we're going forward. So price is manipulated before the down move 1.5 standard deviation. So as you can see, not quite 1.5. We're looking at more of 1.25 standard deviations. So after the standard deviation, you see a strong move, reaches into that standard deviation zone. You've got your price manipulation. If you look here, after the 5 5 GMT candle, you know, we're expecting bearish moves as we've already stated. We've got price being manipulated up. We're going to be looking for 1.5 to 2 standard deviations on average before London open. So then you've got London open here. You know that price has followed market structure into the standard deviations, comes into this zone here, and then boom, okay, we've reached into 2 standard deviations. So now you can have a higher level of confidence of knowing that price is being manipulated. And then as you see, we come into London open and already market structures started to move massively down, you know, and that's where you would be looking to take your entry in this zone. And then obviously as price comes back up, like we said with your stop loss, this would be this would mark a zone where, you know, you would still be in this trade, and this was an 86 pip move. So this is the best time to enter, typically, is in London open. Obviously you guys are going to be doing this on your demo account. I don't recommend using real money, just as a disclaimer. You know, I'm not entitled to actually tell you to invest real money, but these are just basically educational insights into the market, by no means financial advice. So price reaches 1 1/4 standard deviations before it turns around and moves in the overall long-term direction of a bearish trend. So I'm going to be showing you guys some more examples of this as we go on. But is everything making sense so far for you guys? Cool, got it. All right, awesome. So we got some responses. Glad to see you guys are getting this so far. Yes, this is being recorded. Okay. All right, let's move on to the next slide. So we've got 5 GMT New York Open referencing manipulation. So we've got the opening of the 5 GMT candle as the reference spot for your entry. So what I mean by that as a reference spot to entry is that you're going to be looking at this zone right here. Let me see. This zone here below the opening of this candle to see price manipulated. And as you can see, price continues to go up into the London kill zone, the indicator that I've mentioned, and then 1 1/4 standard deviations, and then you see the drop, and then market structure comes back up, maybe grab a little bit of liquidity here, then drop again. You've got the 5 GMT price travels above the opening. So you've got, as we've said, you know, we're looking for, because we're in a bearish sentiment, we're looking for price to be manipulated in a bullish market structure environment. Now we know we're bearish from the high time frame, most likely weekly, daily, 4-hour. We know we're bearish, overall bearish. So we know that we're going to be looking for, once the 5 GMT candle is created, the price to be manipulated in the opposite direction to get an entry into London and then grabbing that move. And then I'm going to explain how, you know, why I explained that, you know, why you could hold this move out until the end of the day. I'm going to explain this later in this webinar, not too far from now, of why you could feel confident knowing that if you had your stop loss up here and you had this whole move and then it came back right into break even again, you would be able to understand to hold it out until the end of the day, where that candle closes, to catch the lion's share of the move. I'm going to go over some of this detail as we're going forward. But you know, what I wanted to show you here was the 5 GMT price. This is something you're going to see consistently happening in the Great Britain Pound USD on a weekly basis. I would say 2 to 3 times a week, every single week this happens. I'm going to show you through the charts and live data over the last week. You know, just what you can see in the charts that's respecting this as well. So that brings us to the next slide. Clear entry during London open. So as I've stated, you know, with the confluence of your standard deviations, market structure being manipulated after the 5 GMT candle into 1 1/4 standard deviations, and then boom, London open. Look at, catch the majority of a very, very large move in here, and then as it comes down for the rest of the day, you could catch this whole entire move. Now I know this looks like hindsight, you know, just cherry picking, but like I said, I'm going to bring you guys through actual charting of the charts and show you how many times this actually happens. But I just want to show you guys examples of, you know, the strategies that I use on a weekly basis of getting in at a price and knowing basically what I'm going to be looking for as far as an entry, what I'm looking for as far as manipulation, and where I'm looking to exit my trades. And hopefully this brings you guys some insight inside your charts as well. So more examples and explanations. So brief overview of the Great Britain pound US dollar previous data, why these levels are consistent. So like I said, I'm going to bring you through live charts now. You know, why these levels are consistent is because this is the central bank dealing range. So as I've said here, you know, we've got the central bank basically of the United States. What it's doing in this time zone is it's pretty much, it's algorithmic based, so it's understanding that it's looking for float. So it knows it has stop and buy orders here. It's got each standard deviation, so it works on a standard deviation basis. So, you know, it's got stops and liquidity under here and one standard deviation away. It's got stops and liquidity 2 standard deviations away. And it understands that, you know, obviously if the market structure is poised to go lower, that it's going to be looking for its manipulation to grab liquidity to go lower by going where? Obviously bullish first, right? Makes sense. So you've got the market structure as far as the central bank dealing range, knowing that it's going to have liquidity a standard deviation away above in the opposite direction. As far as sell stops, buy stops, pending orders, it's going to have standard deviation, 2 standard deviations away. It's going to have liquidity, so it's factoring in basically, you know, it's able to understand and know where the majority of orders are placed and how much it needs to continue to see its price action go lower. So what you want to do is focus on the strategy on Euro USD and the Great Britain pound. As I've said, you're going to see the most amount of conviction in those 2 pairs and consistency. The best times to use this strategy are in trending environments, obviously, and on Tuesday, Wednesday, Thursday. Since Sunday and Monday there is very little conviction in the direction, and Friday the market makers are closing their orders before the weekend, so obviously they don't want the overnight charges that they're going to receive on massive orders. So I'm going to stop here and go live into the charts and show you guys some examples of real price to show you, you know, this is not just all hindsight. There's definitely this market structure happening on a continuous basis every single week. And even this week alone, you know, we saw some very great examples of this happening in the market. So let's see here. I'm going to quickly change a couple things. So, all right. Yeah, I'm just deleting the 12 GMT time zones. It plots it out on my chart for some reason. The indicator that I use plots 12 GMT. I don't need that number. It doesn't represent anything for me. I just need 0, 5, and 20. So I'm just going to get rid of the 12s to eliminate the confusion that you guys might see on the charts here. Okay, there we go. We should be good now. Okay, so what I want to show you guys is, let me get rid of these pivots as well. See if I can get rid of them quickly. Maybe not. That's okay. Alright, so let me zoom in. So we've got obviously our higher time frame directional bias is bearish, as you can see. You know, we're obviously looking for very bearish market structure for the most part, but there's times in here where you're going to have to factor in, obviously, knowing that you're going to be searching for liquidity as far as grabbing liquidity to continue to go bearish. And what this is going to be in the form of is, you know, what I like to look at is market structure following bullish or bearish order blocks. So as you can see, you know, I've talked about order blocks in the last webinar, and in depth. If you guys want to reference that, you're just going to have to go back into the webinar, the last webinar that we did. We explained order blocks and the whole market structure with that. I don't want to repeat myself here, but if you look, you know, if we were looking for market structure to go bearish, I would be monitoring where the bullish order blocks are, bearish order blocks in the sense of, you know, knowing when the bullish days are going to be happening, to see market structure having, you know, a couple up days or a couple up candles on a higher time frame, knowing that obviously the overall sentiment is bearish, but factoring in that we're going to have days of up days to grab that liquidity quickly, and this is the sense of in the form of an order block, as you can see. So as we go down into market structure, let's look at some stuff here now. This added these 12 candles or 12 patterns again, which I don't understand why it does. So let me quickly get rid of these annoying things again. I think it's just when I go on the higher time frame, it just adds these back in on me. Alright. Bear with me. How many more of these did that add? Okay, well, we can't be doing all those, so I'll just delete them as I'm going. So just try to ignore them as much as you can. The 12 delineation anyway. Okay, so let's look at market structure here. So we've got, obviously, we've got our 5 GMT, which I've said is the manipulation zone from the central bank dealing range. You're going to be looking for price to be manipulated during this time. You've got 0 GMT delineating the start of the day as far as the charts, and on my brokerage anyway, and then we've got 20 GMT representing the lion's share of the move. So as you can see, you know, at the end of the day, the majority of the whole entire move is pretty much over by the time you reach 20 GMT. 5 GMT is where you're going to look for the manipulation. You're going to be plotting your entry point at the London kill zone. 0 GMT is when the day starts, and then obviously you have your central bank dealing range here where you're going to be factoring in the standard deviations. Now, you're not always going to need to factor in standard deviations. You really got to look at price and understand a couple of factors, obviously, between the day of the week, the time, not so much time of day, but the day of the week is obviously a factor, and knowing that, you know, where are we in the day of the week? As you can see, this is Friday's pricing here. So what do we know about Friday? Well, I've said it already, is that banks and institutions are going to be closing the bulk of their orders so they don't have an overnight charge on the weekend. So as you can see here, you're going to see maybe a little bit more conviction in the sense of not actually having to put in standard deviations, because you know that, okay, well, it's Friday, so I'm going to be looking for the majority of my trades to maybe not be manipulated by that much, right? Because you've got the majority of traders wanting to close their orders before the end of the day. So let's look at market structure here. So we've got our opening candle here, all right here. Okay, so 5 GMT delineation, New York open. This is the candle that we're going to classify the midnight of New York candle. Boom, right there. Now we're going to be looking for market structure to be being bullish anywhere above this zone. We're going to feel comfortable knowing that obviously we're going lower. The market's poised to go lower. We're going to be looking for obviously our standard deviations, but because it's Friday, we're not needing to really factor them in. But if you look, you know, come London, it's not really, this isn't that great of an example, but as you can see here, you know, if you really, you know, look at this, you've got this candle here, and it obeys it perfectly. If you look at London session, boom, London open, right in London open. You can catch that entry right there. And then, you know, that's what we're looking for, is price to be manipulated after 5 GMT in London Open to catch the entry of our move. Let's say, you know, we're putting a 20 pip stop here based upon, you know, our risk management, our strategy. So 1.32572. All right, so we've got our stop loss here, right? Let's change this around a little bit. You know, we've got our stop loss here. We feel comfortable taking that order during London Open, you know, and then boom, London Open. And what did I say? I said we're going to be using 20 GMT to be closing out our position. So once the 20 GMT candle closes, that's where we're going to be taking our close for the portion of the day. So if you look at this, you know, let's say you were waiting in London Open for it to be manipulated. So first it came down, you wanted to wait for it to touch, following your strategy. Let's say you caught it right at the top of the move, knowing that, you know, price is over here, it's manipulated above the opening of 5 GMT. You know, you held it out. Let's say you closed it at the end of London Open. That's still 45 pips. You know, but let's say you held it until the end of the day. That's 188 pips in that move. You know, and you can catch it anywhere in between there. I like catching obviously the majority of the move, because I mean it's there, right? And that you're going to see how often this happens. It's going to blow your mind. All right, so let's see. Let's delete all these lines here and let's go to the next example. So as we can see here, let's go to the next one. All right, so we're obviously expecting what? Again, we're expecting bearish market structure in the sense of, you know, we're in a bearish trend. We're in Thursdays. This is Thursday's trading here. So we come into Thursday's trading. What do we got? Okay, now we're looking at some differences here. So we've got, you know, the 5 GMT candle. We've got our central bank dealing range. We've got the London kill zone, London Open kill zone, then the end of the day. So, you know, if we look here, we've got, let's insert some shapes here to delineate this price. Boom. Okay, so we've got our central bank dealing range, right? So now to plot out our standard deviations, we're going to be looking at placing the same size box. Boom, right? And then we place that on top. Same size. Change the color. Let's do an orange. All right. So boom, okay, we've got our 1 standard deviation. So let's go into next. Right, so we've got our 1 standard deviation here. So we've got 1 standard deviation, and where does price go to? It comes in about, what did I say? We're looking for 1.5 to 2 standard deviations. We almost got a full standard deviation here, right? As you can see. See if I can grab this trend line here. Probably not. That's all right. But anyways, we've got our 1 full standard deviation just about. You know, we're pretty close to the top of that. Let me see here. There we go. You know, we're pretty close to the very top of that standard deviation, as you can see. So we know that as price is going into standard deviations, obviously the market's poised to go lower. We're going to be looking at next is our 5 GMT candle, right? So we come into 5 GMT, and what are we looking for here? We're looking for manipulation above this price. So now we come in here. Let's change this back to solid. So we've got our 5 GMT candle here. Now, you're not always going to get a full confirmation of the London kill zone being above the manipulation, but what you can factor in here is that you already know that you've went 1 standard deviation. So by factoring that in, you understand that first of all, we're after the 5 GMT candle, we've went 1 standard deviation, we've came back down, we have London Open. Now we know we've went one standard deviation already, so we can probably feel pretty confident that, you know, this market's going to be going short. We know our best entry is going to be in London session. So let's say, you know, let's say for this instance you got in at the very beginning of London session because you're confident that this thing's not going back up. You know, you put your 20 pip stop loss here. I use 20 pips. I'm just going to use this as an example. 1.32649. All right, so let's plot our stop loss. 1.32649. All right, so that's going to be our stop right here. And what do we got? We got market structure. Let's say we took our entry. It goes against us 4 pips. We're way inside the range of our stop loss. Now, okay, let's say you want to catch it and close it out at the end of London. You got 42 pips. Let's say you want to hold it to the end of the day. You've got 34 pips from that move. You know, that's some pretty good conviction of knowing what's happening in the markets once you see this going on. So as I've said, you're going to be using this time zone 20 GMT for the close of the day. So this is when you're going to want to close out the bulk of your profits. As you know, it's going to be the lion's share of the move. All right, so let's move over some more. So let me see if I can. All right, what else do we got here? Okay, so we've got our markets obviously going lower, higher time frame once again. So we've got market structure here, central bank dealing range. We've got our standard deviations. All right, so there's 1, 2, bring this down. Okay. 1 standard deviation. All right, then we've got, you know, we draw this across in time. We've got, you know, half a standard deviation. So not that much, but still we're into the standard deviation zone, which is a good, obviously, zone to understand where market structure is going to be manipulated. So then what else do we go to next? We go to our 5 GMT candle. So we got the 5 GMT here. You come here, plot out your 5 GMT candle. What are we looking for? We know that the market's poised to go lower, so we're going to be looking for short positions during London Open, kill zone, and we're going to be factoring in knowing that price is going to be manipulated on the upside. So as we take our 5 GMT candle, we're looking for price to be above it. Anywhere above it is where the manipulation is happening, which is good. We're looking for you know, our entry in London. Okay, let's look here. So we've got let's say, you know, we've got this one. You might have not done as well on this one, but still, you know, it's still pretty much following the market structure of knowing that in London Open, you know, you're into the standard deviations here. Let's say you took a short in here, you know, somewhere. Let's give you half the move. We won't be fully, you know, let's say that you waited a little bit, because you don't want to. The worst thing to do is obviously buying high and selling low, right? So let's say, you know, you waited a little bit inside this move. You're going to be looking for the standard deviation confluence. Another thing you're going to be factoring in here is on the higher time frame, obviously. Well, what I factor in is the order block. So I look at market structure. Like I said, some days you're going to have those up candles where it's got to grab that liquidity. So let's be, you know, a little conservative here. Let's say your stop loss is here, 20 pips away, 1.32334. Okay, so your stop's going to be here. Let's say you wanted to wait until you're inside the standard deviation zone, which I would recommend on days that maybe aren't as clear. And then, you know, let's say, you know, you caught the move here. By the end of the day, you're still grabbing 22 pips on that close of that candle. Or let's say you want to exit during, you you know, you want to exit during London close, or the closing of London open. Still 25 pips. So you can see there's a higher level of consistency with this strategy. I'm going to go through one or two more examples to show you. As I said, you know, like the day of the week is obviously going to also be a factor. What do we know about Thursdays? Thursdays, we know that, as we've said in the last webinar, Thursdays typically you're going to see the reversal of the market, you know, to grab that liquidity, seek that liquidity. I've explained this in the last webinar. If you reference it, you'll hear me saying, you know, Thursday you're looking for a potential reversal. Now, you know, we caught a short here still, but in the sense it's, you know, we still typically have quite a lot of bullish movement here, right, in this zone, because Thursday is the reversal day, but then Friday it comes back to normal again, as you can see. All right, so let's go to Wednesday's trading. So what do we got on Wednesday? So we've got our central bank dealing range here. We've got the opening of the candle as far as 0 GMT on the charts. 5, this is where we're going to be looking for the manipulation. Now, we don't have any standard deviations, so we're going to be looking for manipulation after 5 GMT candle. We know the market's poised to go lower, so we can know that, okay, 5 is going to be the opening of the candle. We're looking for manipulation and above that price to go lower. Now, as we factor in, okay, 5 p.m., price is going above. Now we're looking for an entry in the London kill zone that's above the 5 GMT candle here. Now what do we get here? We don't have any confirmations here until the third candle, but look at the third candle. Boom, right above this central bank manipulation at 5 GMT, you know, and then boom, okay, we've got 31 pips if you close it out during London. If you held it out for the majority of the move until 20 GMT, like we've talked about, that's 130 pips, right? Look at that, and ignore this here. We got another 12 delineation we don't need. But look at that, you know, you can see how you're catching the lion's share of the move every, you know, you're looking for this strategy. It's not an everyday basis. You're looking for it, I would say 2 to 3 times a week. This is going to happen on average, which is still a great amount. So are you guys getting this so far? If you have any questions, feel free to ask them. Let me see. We got a question here. Okay, let me see if I can. So the standard deviation is roughly the movement that price is being manipulated before continuation in the direction of the sentiment. Correct. Yes, that is correct. That's what we're looking for. Is the standard deviation is the central bank dealing range, and then what that's representative of is one standard deviation outside of this central bank dealing range is considered, you know, this is part of the manipulation process, is the standard deviations. The most you're going to see it go is maximum 3, and that's on very volatile days. Like you'll see that on maybe FOMC or non-farm payroll days, but on average you're going to see 1.5 to 2 standard deviations away from price. Okay, let me look. There's a couple more questions here. All right. And what time is the standard deviation calculated? This is calculated in the time zone that I use is, if you look at here, the range that I'm using as far as my platform, because mine factors in GMT plus 2 or 3 depending on daylight savings. So I'm using 20 GMT and then 23:59 GMT. I don't know which you know, which brokerage you guys are using. You're gonna have to factor that in to yours, but mine is I use GMT plus 2. So I was referenced this strategy with 18 GMT, so I added 2 to it to make it 20 GMT, and then I kept it 23:59 for the end period, and that's what works the best for me. This is the delineation that I use, and it's the most consistent. So you guys are just going to have to figure that out compared to your brokerage, which brokerage you guys are using in the time zone for that brokerage. All right, let's look at another example here. What do we got? So, you know, as I've said, you know, you've got some days where you're going to have up days, some days you're going to have low days. So what do we got here? And some days this isn't a guaranteed strategy, right? This is just something that we're looking for the most amount of probability. This is a strategy that I've found a very high level of probability in, at least 1 to 2, 3, sometimes 3 times a week, sometimes more, sometimes 4 or 5 times a week. So you're gonna win some, you're gonna lose some, but the winners, you're obviously winning a lot more on the winners than you're losing on potentially the losers. That's for sure. So let's look. Do we have anything here? I don't know what day this is. This is September 12th. This might be Wednesday. Oh, that might be a Monday actually, because we've got 3 days prior to that market closing. So yeah, that would be a Monday. So I probably wouldn't trade this one anyway. Like I said, I don't use Monday or Sunday because the market has no conviction in the overall direction for the most part. So these moves are less probable. You want to stick to Wednesday, Thursday, and Friday. Okay, let's look at one more, and then I'll move on to the next topic. So we've got here. This is Friday's trading. This might be Thursday or Friday's trading. I think it's Thursday. Okay, so we've got our standard deviation zone. Let's plot out some stuff here. So we've got, obviously our central bank dealing range right in here. All right, to the top of that zone, let's insert another shape. Get the standard deviation. Okay. All right. Move that above. We've got, and look at this, we're looking at 1.5 standard deviations as stated. All right. Let's do one more. All right. Boom. All right, let's do a different color here. All right, so we've got 1 standard deviation here, 2 standard deviations. And if you look, we've got price coming into, as we've said, we're looking for 1.5 to 2 standard deviations. We're almost at 1.5 perfectly there. Look at that, almost right to the half point. Then we're looking, what are we looking at next? We're looking at the manipulation after the 5 GMT candle. So obviously we know the market's poised to go lower from the higher time frame bias. We're going to be looking at, and if I showed you guys the higher time frame, you could clearly see, which direction the market was poised to be going in. And also, you guys can be factoring in your support and resistance that you're using to help you to confluence some of these factors as well. So as you can see here, we've got the 1.5 almost standard deviations. We've got market manipulation after the 5 GMT candle. We know that we're looking to go bearish, so we're looking for manipulation on the upside, and then we're going to be looking to be taking, let me get my spotlight out, we're looking to taking our entry in London Open. So we know that, we've got, let me get rid of this quickly. We've got our London Open here. Price is above. We've hit 1.5 almost standard deviations. So we've got some great confluence here. And then what are we going to be doing? London Open, we're going to be factoring in 20 pips stop away from London Open. This is what I recommend. And I mean, it's a pretty conservative approach. It's not too aggressive. 20 pips is not that much. If you're factoring in your risk management properly, this should be no problem for you. So 1.33461. All right, so there's our 20 pip stop. All right, and then what are we looking for? We're going to be taking our entry in London Open, and when are we going to be closing it? Either at the end of London, for you guys that are a little bit more conservative, or at the end of the lion's share of the move, 64 pips, a 20 GMT. So you can see how this is not something that just happens once or twice. You can see how this is pretty consistent. This is something that I use on a weekly basis. That is like, this is basically, I look at this as my, if I didn't trade if I wasn't going to trade the whole week, let's say I'm going on vacation, I'm going to bring up my charts, and this is the strategy that I'm going to use from a conservative approach of, I know what's going to happen at certain times, and I can feel confident in what I'm looking for, and feel confident with either if I'm placing pending orders, or I don't want to be too worried about where I'm going to be taking my entries, because I have consistency and a good level of confidence, then I can feel pretty confident. Did you guys want to see some more examples, or is this pretty good so far? I feel that I've expressed it pretty clearly, but if you guys have any questions, let me know. So far, no questions. Pretty clear. Awesome. Is this helping you guys so far? Giving you some insight into how the markets really work? An Asian example. Okay, I can try to show you an Asian example. I'm not too sure if this is going to be as good on the Asian sessions. I know I like to use this more for Great Britain pound and Euro USD. But definitely, let me do an Asian session. Let me see here. All right. All right, let me see what I can do. Fair enough, that's fine. This is great, beauty. All right, I'll do a couple quick Asian examples, see if we can find something. I don't typically use this strategy for Asia, so I don't know if I would even recommend it. But let me see what we can come up with here. All right, so let's get rid of our indicators first of all. All right, 0, 12, 5. I do use a different strategy for Asia, but I will show you that, I don't really like using this strategy for Asia. I use a totally different strategy for Asia. Okay, let's see what we got here. 5 GMT, 0 GMT. The only numbers we don't have is 20. Let me see if I can copy this template. All right, let's try Asia. Okay. Get rid of the 12s. You're not going to be using them. All right. Okay, so we've got here, let's look, let's see our standard deviation central bank dealing range. So we've got, there we go. All right, so 1. Let's do one more here. Okay. So we've got our 1-2 standard deviations, our central bank dealing range, and then we've got our 5 GMT candle. Obviously, we're using USD JAPI, so you guys have been trading all week. We clearly all know that the price sentiment is very, very bearish. So we're going to be looking at the 5 GMT candle right here. We're going to be looking for manipulation above this candle into the London kill zone. Okay, so boom. We've got London kill zone. We've got the opening of London right here, the very first candle, draw it along in time. 2 standard deviations just about, right? And what did I say? 1.5 to 2 standard deviations. No, let's put if you put a 20 pip stop, it would be well above the zone that it went in. You know, we're looking at manipulation, like I said, above 5 GMT, London open kill zone. And then what are we going to be doing? We're going to be taking our trade. You can close it out at the end of London kill zone, so you'd be getting about 26 pips, or you can wait until the majority share of the line share of the move when the daily candle closes at 20 GMT. That's 91 pips. So you can see the strategy works on, you know, it does work on other pairs as well. I found that the most amount of confluence I had was on Great Britain pound US dollar. I do use a different strategy on USD JAPI, but I get, you know, you can see that it works also on this pair as well. So it's pretty clear. I mean, it works very, very well. It's very effective. You know, I've done very well with this strategy just in itself. All right, you guys, is that good for the Asian pair as well? Did you want to see a couple more examples? That's fine. All right. Okay. Okay, perfect. Good. All right, bring us into the next topic. Okay. All right, so we're going to be looking at next range trading. So this is something that I like, you know, as far as picking my ranges, this is a strategy that I found to be pretty effective as well. I use a Fibonacci equilibrium point, as I'm going to show examples of. I do have different levels here, as you can see on my Fibonacci. I'll be going over these levels so you can implement it into your trading as well. So definitely some great insight there as well. So what I do is I plot the high and the low. We're on a 4-hour here, as you can see, the high and low of a range, and then I mark off my equilibrium point, which is 58%, or my fulcrum, and I use that as the center point of the range that I'm going to be trading in the future. So I'm going to mark as you can see, I've marked a resistance here, or not a resistance, I've used a level here. I've used a level. Why I have 2 other red lines as well is I use the 100% and then the 0% of my Fibonacci. So from the top of the range, I mark off a nice horizontal line on the 50%, and then horizontal line on the bottom of the range as well. Now it's going to this is going to be able to factor in for you guys some great overbought and oversold areas just from range trading using this strategy alone. This is what I love to use when I'm factoring in range bound trading. So I use, as I said, horizontal line at the 100, at the 50, and then at the 0. And then what I do in the next picture, I have I plant my Fibonacci. As you can see, you know, I have it from the top to the bottom here. What I do is I'm going to put from the middle of that overall range, I'm going to plant the Fibonacci from the top to the bottom of that, and then I'm going to use the 50% point to plot out my oversold, and then I'm going to do the same thing from the top to the bottom of that range in there, from the 100 to the 50%, and then I'm going to use the equilibrium of the 50% point right here also as the overbought. So as you can see, plant it there on the bottom here, and then the next one I'm going to plant is right here at the 50%. So then that gives me, if you look here, I've got, you know, my overall Fibonacci was from the top to the bottom of the range, plotted out my 50% equilibrium. Then I plotted my Fibonacci from the top of that range to the 50% equilibrium, got another equilibrium of 50%, and then I plotted the Fibonacci again from the top of this equilibrium to the bottom of the zone, and I got another 50% equilibrium, and I used that as my oversold and then overbought. So as you can see, obviously we were on the higher time frame, so a couple of things you can factor into this is, you know, that maybe that strategy that I just showed you guys, you can use fib on your swing highs, swing lows, a couple other strategies you guys use as well, but this is definitely great for oversold, overbought as far as, you know, plotting out on your own chart. So now look, you can see, wow, we're clearly overbought here, you know, and every time it comes into this overall zone, we're looking at price turning around in it, you know, boom, boom, every time it comes in here, you know, some great turnaround points in here. That really helps me to situate my overbought, oversold. Okay, so the Fibonacci's that I use, the levels are going to be, you know, you have your, if you take your Fibonacci and you replot the levels, I've got 0, I've got my 100 level, 79 optimal trade entry. This is a great spot where you see a lot of price action reaching that 79% optimal trade entry and turning around, or it reaches the sweet spot, which is 70.5. I find that those are some great areas. 62% is also good. I use the equilibrium or fulcrum 50% to plot, you know, my range bound trading, and then I use my extensions as well to plot out, you know, possible take profits. So going to the next slide. So as you can see here, I plot my swing high to my swing low for my Fibonacci, and with my levels that I was just showing you guys, I have the extensions at 127 and 162. You know, you've got a great spot for take profit with that Fibonacci, for take profit 1 and take profit 2. This is a great tool that I like using for figuring out my zones. You're able to use the extension levels as take profits, so that's pretty great great use of that Fibonacci that I use in my charts. So I just wanted to, that's pretty much sums up the webinar. I just wanted to give you guys some examples that I use in my charts of some advanced topics. Obviously I don't want to bombard you with too much information, but I definitely wanted to just give you guys a glimpse of what will be in the MastermindFX website in the future, some of the advanced techniques that we use. I hope this helped you guys by showing you, you know, some clear indications of, you know, what actually happens on the charts at certain times that your eye might not be adjusted to. But once you just do a little bit of adjusting, you can clearly see, you know, things happening in the charts that you can really profit on that, you know, I used to miss all the time. I never even knew where they were there. And then once they were shown to me, you know, it changed everything for me as far as insight into the charts. So I'm gonna pretty much end it off there. If you guys have any last minute questions, feel free to put them into the box. I'll be sending out the indicators via the chat room, and then you know, we'll be having obviously webinars in the future as we're going, and more advanced content, stuff like that. But if you guys got some good insight out of this, feel free to, you know, send any feedback about, you know, any questions you have, or if it's helping you in the charts, let me know, and you know, we can definitely go forward and with some new material in the future for sure. If you guys like this, there's a lot more content that I can help you guys out with. All right, so I'm not seeing any questions. Oh, got a question here. Will we get access to the webinar and or future webinars? You'll get access to this webinar. I've recorded it, so I'm gonna, I haven't decided yet what I want to do with it. There's a couple of things I'm factoring in my mind of what I want to do with it. But as far as future webinars, I'm working on some stuff with some people of structuring the website. I haven't decided, you know, what the plan is as far as yet. I do have to talk to a couple people because they're also a large part of the website as well, so I'd have to pass it by them. But we'll definitely be working in something in the future to keep everyone involved. Would like to watch it again or the PowerPoint. Okay, yeah, no problem. Alright, I think that's pretty much it. No more questions? Alright, I'm going to end it off there then, guys. Thanks a lot for coming in here. And, oh, was looking for information about market timing. This was helpful. Glad I could help. Glad I could help. Awesome. Understood it all, just got the time frames you guys use. Got to get the time frames. Yeah, definitely. I mean, if you have any questions as far as the time frames, just feel free to ask me. I like using a higher time frame directional bias from plotting my trades, but definitely coming down into like the lower time frames for things like the central bank dealing range and stuff like that. I use typically the 15 or the 5-minute to factor that in. You can get an even more precise entry on the 5-minute. I like the 15. It's pretty good as well. Oh, the times that we use. Okay, yeah, no problem. No problem. Yeah, just if you have any questions, you can actually just ask me personally, or you can send us an email, or if you go on our website, all of our contact information is on there as well. We have questions every single day from people asking, so feel free to ask. GMT is basically local time for European London. That is correct. Yeah, GMT is Greenwich Mean Time. So yeah, you're looking at more. I would say it's more of a European time zone. It's just GMT is the way that the charts are plotted out. As far as the MT4, I'm not sure why they use GMT. I think basically the world's time is pegged against GMT, so that's why they use it. But what we're specifically paying attention to is just formulating our indicators in our session times to factor in New York, the central bank dealing range. That's what I like to take a lot of my trades off of, this zone here. So that's where you're going to see the most amount of the manipulation is after this zone in 5 GMT. This is we classify this as the opening of New York. Now it's not the opening of any sort of candle on a higher time frame, but this is the delineation that the central bank uses for price manipulation, grabbing liquidity. So this is the level you want to pay attention to the most as far as market structure being manipulated after that. Definitely. Yeah, no problem. No problem. All right, glad you guys enjoyed it. Looking forward to you know, some of your feedback. Let me know. Try this out in the charts. I'm going to be sending you guys the indicators. I want you to try it out in your charts, obviously on a demo account, and then you know, let me know how that goes. I don't recommend, as I said, using live funds because I'm not entitled to do that. I'm not a financial advisor, but definitely try it out in your charts and see how it works out for you guys. I know I get great entries from it for sure. It gives me a lot of insight into the markets, so. All right, guys, gonna end it there. Thanks a lot again for everyone that came through. Don't want to hold you guys up too long. It's a beautiful Sunday. Spend it with your family. Spend it out enjoying the weather while it's here. If you're living in Canada, we're going to be getting some cold weather in the future, so not too long from now. So enjoy it while it's here. All right, take care, guys. Thanks again for coming.